And good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and welcome to another Wednesday afternoon webcast. During this webcast, we will provide you with a brief macro overview, and of course, at the end of the conversation, we will be pleased to address your questions. So please email me, phastings@barometercapital.ca, or you can hit me up on the chat via Zoom. And with that, I turn the conversation over to David Burrows, our Chief Investment Strategist and President at Barometer Capital. Good afternoon, David.
Good afternoon, Pam. How are you?
I'm great, thank you. How are you guys?
Great, thanks. Good to see we got a bunch of folks on the line today, and here we are in the first 3 weeks of a new quarter, and just into earnings season. And I know the team has been very busy this week preparing for all the earnings reports and sifting through the data. And I've got a few things to share with the folks today. So why don't we get going? Good. So thanks very much, everybody, for tuning in. We got lots of people on the call today. What I'm going to try and do is just sort of revisit our key themes and how things gone over the course of the past week. Look at some of the data points that have come in and how they might relate to some of our theses. And what, if anything's changing in the portfolios. Just to start right from the top, as always, from an asset class perspective, we are in a structural bull market that started in 2013 when we took out the 2000 highs. Characteristics of a structural bull market, they go on way longer than people expect. By the time they start, they've been through enough disappointments, in this case, like 2001, 2, and 3, and 2007, 8, 9, that they have a hard time believing that a rally could take hold and continue for a long period, of course, with interruptions like we saw in the 1980s and 90s, in the 1950s and 60s, and the 1920s. So the market has been working its way higher through the course of this pandemic. I think to a lot of people's consternation, a lot of cash stuck on the sidelines, a lot of money got pulled out of the market early last winter, and has yet to be redeployed. Certainly money is going in pretty steadily, and people are buying the dips, but backdrop for equities in the US and of course now globally, equities have a tailwind. We think that we've been going through a generational bottoming in long-term yields, bond yields, that probably started in 2015-16 and appears to be resolving to the upside. And much like it took that several years through the late 1940s and early 1950s to reverse from a disinflationary environment kicked off in the 1920s into a reflationary environment that eventually, of course, turned into an inflationary environment in the 1970s. Commodities also going through their own change. We've been making a case that we're going through a secular bottom in commodity prices and a reversal, and that's taken hold over the last year. And the bear market went on from sort of 2008 through 2021, 13 years. So the S&P continues to work its way higher as it has been since 2013, with, of course, some interruptions in 2015-16 and 2018, of course, during this pandemic, but in a fairly tight channel. And the S&P continues to work its way higher. Now, we note that we have had a number of little pullbacks as we've come into month ends over the last few weeks, a few months, and that's been because equities have been a significant outperformer versus bonds. In the recent month, actually, bonds have had a little bit of a bounce, so a lot less dispersion between equities and fixed income, so probably less rebalancing to do in the upcoming month end than we've seen recently, but certainly equities continue to work. From a bond perspective, bond prices have been working their way lower since last February, when we saw what we think was a generational low in long-term bond yields globally. And we've mentioned over the last few weeks that we were bound to see them bounce a little bit. They've had a number of sort of corrections and bounced their way higher. This is bond prices higher and bond yields a little bit lower. And that certainly has taken the pressure off some of that rebalancing that has had to take place. The one thing I would point out, though, is that the fall in bond prices broke not just one low, but two lows, three lows, and we broke the long-term trend for interest rates. And this likely was going to give us a bounce back up into that trend line, which we've now had. So my guess is that the rally in bond prices or the pullback in yields is probably more or less run its course. And we may, of course, track sideways for a little while. We may not see yields push higher immediately, but I do not think this is the time to be buying fixed income. The long-term trend is broken. And in fact, the sell-off in bond prices that we've seen since last summer is the most significant sell-off since the bull market in bonds began in 1981. So we think this does signal a significant shift. And that means a lot for what we do with our investments, because as I've been saying, what works in a reflating environment where asset prices are moving higher and growth picks up is quite different than what works in a low growth, low inflation environment, different types of sectors. And those sectors, I think, still are really overowned, are very, very expensive. People have built a lot of confidence in them, and it's going to take them a long time to unwind these positions. US dollar has been weakening since last fall. We mentioned that we got this little bounce through into the end of the quarter last week. This is the chart I put up. I said it looks like that has sort of run its course. If we move forward another week, US dollar has weakened further. It looks like it sort of ran into some resistance. And seasonally, that would be typical for the US dollar to strengthen a little early in the year and then weaken through the course of the year, through into the fall. So that appears to be the case currently. So that has implications. When the US dollar rallied, it put a little pressure on some of the things that do well with a weak US dollar, like, for instance, commodities. And since the US dollar started to pull back, commodity prices started to reaccelerate. So this is a long-term chart of the Rogers Commodity Index back to 2008. It's a compilation, unweighted, of a large universe of commodity prices, agricultural commodities, metals, forest products, chemicals, and so on. And you can see that we broke that long-term trend just 3 months ago. These reached monthly bars, and commodity prices continue to firm. So let's check in with some of the data from this week to see if the thesis continues to play out. And the thesis is we have started to reaccelerate into a new business cycle that, just from a cyclical perspective, should be 3 to 4 years in length. And that favors industries that benefit from a stronger economy and where their products can be in short supply and they can have some pricing power. So we talked in the last call about the fact that job postings have been growing quite rapidly in the US. And while employment is still a long way from where it was before the pandemic, things are certainly getting better. So let's go through some of the data. First of all, on the vaccines, nice acceleration going on a day-by-day basis around the world, and the percent of the population being inoculated daily. Of course, the US is leading at a little over 1% of the population per day on a 7-day average. Canada, while had been lagging, is certainly starting to improve and improving relative to some of the European counterparts. And so this ultimately will find its way through the data. But let's take a look at what that means in the real economy. First of all, the most recent jobless claims had a significant drop, expected to come in around 900,000. Jobless claims came in at 576,000, much better than expected. From a manufacturing perspective, this is a measurement of unfilled orders. And we can see that there has been a significant spike in unfilled orders. Our premise is that given all of the stimulus put into the system, there is likely to be a very significant bounce in economic activity as the pandemic comes to an end, or as things start to get better. Not just because of the stimulus, but because people are ready to spend money and there is pent-up demand. Certainly, we're seeing a big pickup in unfilled orders. We're also seeing a fairly precipitous drop in inventory levels. So what does that mean? It means there's going to need to be restocking. There's going to be a pickup in demand for manufacturing. So that flows through. Manufacturing prices paid, spiking, and manufacturing prices being received are spiking. So again, this is probably a little bit inflationary. It's probably stimulative to the economy. And this helps to move us away from this disinflationary environment. Retail sales, most recent number for the month, up just about 10%. So a very significant increase year over year. So this is leading to a pickup in CPI, certainly in cities for sure. It's something that is likely to continue. We talked about the fact that we have yet to see an impact from recreational services, which are still at significantly depressed levels, but headline CPI is certainly picking up. Now we're into the earnings period, and earnings are the fuel for stock prices. And it's not just are they growing, but are they meeting expectation or beating expectation? Now, arguably, we're early in the earnings season for Q1. 73 out of 500 of the S&P 500 have reported their numbers. On average, beaten revenue estimates by just about 5%. So that means analysts have been fairly conservative in their numbers. They've beaten the earnings estimates by 37%. Now, of course, various sectors doing better, various sectors doing worse, but that's a pretty big beat. Now, we like to compare how it's going for the S&P versus how it's going for the companies that we have chosen to invest in. So versus a 37% average beat for the S&P, in our portfolio holdings so far that have reported, the average beat on earnings was 69%. So just a little over, just about twice what the beat has been in the S&P, and our sales surprise numbers have been closer to 12%. So first of all, the numbers so far, albeit we're only about 20% through the S&P earnings, are coming in ahead of estimate. Second, I think that there is disparity between companies as to who's doing well and who's doing better, who's doing worse. We're pleased that the investment team, the research team, done a great job from a security selection standpoint to find companies that are significantly beating analyst estimates. That's supportive. So let's talk about some of the leadership teams and how they've reacted over the course of the week to some of the data. And of course, we are waiting for earnings in a lot of cases, so we're in a quiet period. Share buybacks are on the side burner because corporations can't buy back their shares in the short period leading up to earnings. They have more information than the public. So that has an impact. And often we see some bumpiness headed into earnings because there is a lack of information. We talked about the fact that coming through quarter end, there was a lot of rebalancing and there would be some turbulence sector to sector and asset class to asset class. Frankly, given $300 billion worth of equities that were for sale through quarter end, markets held in pretty well. Those cyclical sectors that we're focused in that have been outperforming defensive significantly since last fall did certainly have a little bit of consolidation in the last couple of weeks of April and last couple of weeks of March and first couple of weeks of April, but that appears to be resolving. So let's just run through the basic themes. From a value perspective, the value portion of the S&P 500, this is the RPV ETF, it's a value ETF, has been significantly outperforming since October, certainly consolidated through the middle part of March and into the early part of April, but looks to be ready to reaccelerate. Let's look at the key themes. The XLF index, which broke out for the first time in February since 2007, after a brief pullback in the late part of March, has rallied nicely and sitting very close to highs. The industrials, of course, a highly economically sensitive group, includes a number of different areas, like, for instance, machinery, defense, aerospace, and transports, has been marching higher smartly, actually really didn't miss a beat through quarter end and continues to be accumulated. I think part of the reason here is this is a group, along with financials, that is relatively underowned by individual investors and by pension funds and institutions, because these sectors have underperformed for so long that there is very little confidence. Yet the numbers are coming in strong. In the transportation sector, we're getting, I think, a tell on what's going on in the real economy. We know that there are bottlenecks. We know there are bottlenecks in trucking. We know there are bottlenecks in rail. And we know that there's bottlenecks in shipping. And that's because there's this big pickup in demand and a restocking that's taking place. And that's a good thing for these companies because there's only so much capacity And it means that if demand is outstripping supply, prices can rise. This is the type of industry we want to be focused in right now, what we call short duration assets, where the pricing cycle can change fairly quickly as demand picks up. And certainly we've been doing well with some of our trucking assets. This is XPO Logistics. It's a company that provides logistics services and transportation to customers around the world. And again, pricing is quite strong. Estimates are going higher for earnings, and coming into the earnings period, performing quite nicely. Now, this week there was some news around the rail sector, certainly in Canada. CP, as you know, made a bid for Kansas City Southern some time ago. Their hope was to take their east-west lines and match them up with Kansas City Southern's north-south lines and really create a powerhouse railroad that would run north-south and east-west, matching up Canada, the US, and Mexico. This week, CNR came in and trumped the bid roughly 20% higher. This has been a deal that was rumored now for many years because CN's lines actually match up against some of Kansas City Southern lines north-south. And in this case, if they were to put these two railroads together, you could take out quite a lot of cost because there's some overlap. Now, our analysts believe it's possible CN was just trying to play spoiler in this deal. There is some question as to whether CN would actually be able to get the regulators to agree to this deal because it would be somewhat dominant in a north-south routing. But it'll be interesting to see how it plays out. The upshot is the rails are taking on some new business because the truckers are so jammed up. Both the truckers and the rails, I think, are in a great spot. And despite some short-term turbulence in the acquirers versus the acquired, this is Kansas City Southern, the rail industry looks robust, and it's one that we want to stay focused in. Commodity prices have remained firm. We pulled back a little bit during March, and then the basket of commodity prices have reaccelerated since then across a number of different areas. Certainly the base metals miners have had a nice pickup, and that would include sort of the copper producers, aluminum, nickel, iron ore. Copper prices, after consolidating, look to be starting a new leg higher. And this is a very important sector because copper goes into so many things, not the least of which is electric vehicles and the electrification of a number of different industries. But copper prices are strong, iron ore prices are strong, and that's good for a number of our investments. Now, we've been talking over the last few weeks about this consolidation that was taking place in the long-term chart of the gold producers. We've had a lot of questions on this. The gold stocks peaked out in 2016, pulled back and consolidated through 2017, 18, 19, made a new high in early 2020, rallied sharply, and then have consolidated. This is a very long-term price pattern. It's a long-term asset. And we thought that we would see at some point the gold producers start to extend out of this consolidation and start a new leg higher, which would measure considerably higher. And that's taken place over the last couple of weeks. It started with the leading stocks like Franco-Nevada and Newmont. It's followed through into many, many of the intermediate sized companies. Today, the gold miners and the silver miners had a very, very good day. So that's important. What's also important is if we take and compare the miners themselves on top versus the actual metal, you can see that since middle of February, the miners have significantly outperformed the metal. Now, the reason that that's important is that in my experience, the type of rally you believe in commodities is when the producers who have a stake in the actual metal itself start to outperform. That's the market saying we believe higher prices are likely in the future and are likely going to stay firming because you're not only getting paid for the production that is current, but all the gold that they have in the ground. And so it's nice to see the gold miners start to outperform the gold itself, because that has been a tell in the past that the rally is for real. And this is not what's been happening over the last several years where the miners have significantly underperformed the metal itself. So commodities look strong. It's a broadening rally. more and more commodity producers, more and more commodity prices for various materials are strengthening. That points to a strengthening economy and an improving economic cycle. There's lumber hitting new highs this week, and agricultural companies also benefiting. Now, the one area of commodities that has been weaker since the middle of March, and probably by no means that it is for good, is the energy producers. And this has been one of the strongest areas of commodities since November, and so arguably probably needed a bigger rest or consolidation. So since the middle of March has pulled back fairly significantly. That's had an impact on our equity portfolio, which does have a reasonable energy weight. But my guess is that, like the other commodities, it will follow through, break its long-term trend line, and head higher in prices as demand and global travel picks up. Consumer discretionary. We talked last week about what consumers plan to do with their money around the home and certainly for travel. The consumer discretionary group coming out of quarter end has firmed up sharply, looks very attractive. We talked about the home builders breaking out of a 16-year bear market going back to 2006. That has continued to strengthen over the course of the week. We talked about the auto manufacturers and auto parts companies. This is Magna's share prices, again, strong through the week. And here is Sleep Country Canada, supplier to the consumer, and certainly people who spent lots of time in their homes spending lots of money on furnishings. So this theme continues to look good. Dividend growth should outperform during rising interest rates. Dividend growth continues to outperform the S&P. This is the ETF RDVY. It's an ETF made up of companies with a history of raising their dividend. We think that rising dividends in this environment are much more attractive than high dividends that don't grow. High dividend payers with low growth have been underperforming dividend growth companies since rates started to rise. That happened all the way through the 50s and 60s in the last interest rate cycle. This is something that we think is just early days and is a theme that will continue. The last area I want to just touch on quickly is large cap growth, specifically large technology companies. We talked about the fact that they had been pressured by higher rates and the fact that they are less cyclical or less economically sensitive than some other areas of the market. That's talking in very general terms. Certainly, we have seen since the end of the quarter a nice pickup in that group, and specifically in companies that are the really big companies that are really taking advantage of the biggest themes like cloud. We talked about Microsoft last week. We talked about Google last week. They're obviously continuing on. We'll watch very closely over the next 2 weeks as to what the earnings reports look like. In a survey that was done by Morgan Stanley, they looked at corporate expectation for spending going forward, and the number of companies expecting to increase their spending by 5 to 10% was 37% of companies, and 22% of companies expect to increase their IT spending by over 10% in the upcoming 12 months. So a lot of that will be in devices like PCs, like peripheral devices for video conferencing, but certainly they plan to spend money in the video conference area and technology for efficiency for their workforce. So that will drive semiconductor sales. We get a number of the large semiconductor companies reporting in the upcoming week. There's always a little sloppiness going into the quarter, into the new earnings period, because earnings for semiconductor companies can fluctuate. But as you may have been reading, there continues to be a semiconductor shortage across many different industries because of the strong demand. And our basic premise has been that semiconductors are the new building block for the global economy, and that whether it's for artificial intelligence, whether it's for devices, whether it's the Internet of Things, semiconductors go into everything. So we'll watch with interest as companies report their earnings in the upcoming week, and then give us guidance as to how they will be able to supply the demand that seems to be outstripping the ability to produce. Global markets. Now, global markets is something we've been talking about because the S&P has performed well from 2013 to present, but many global markets remained in a bear market. And over the last number of months, a lot of the Asian countries and European markets have started to come out of long periods of bear markets. Taiwan was one, today made a new all-time high. The emerging markets looking like they're starting to reaccelerate. And when we look at the S&P since November versus European stocks, Taiwan, Korea, we're seeing a number of global markets actually outperforming the S&P, and that's been an important theme for us in our global macro portfolio. So global macro has been focused in other developed markets, emerging markets, and commodity prices, and in general has been short fixed income and void of bond proxies. It's a multi-asset fund, long short, that's having a pretty good year. So a lot gets determined by flow of funds. Where is money getting put to work? Our job is to use our breadth models to try to identify where the money is going and where the money is leaving. And I want to talk a little bit about that. Last week, we touched on the fact that we've seen money market funds getting put to work, but still at elevated levels, that the flow into bonds has been moderating, and we've started to see a real movement into equities over the last year. And while it's a big number, still does not come close to replacing the money that has come out of stocks since 2018. So we said that we think there's a fair bit of firepower remaining. When we look at some updated numbers from this week, when we look at pension funds and insurance companies and large institutions, yes, we're seeing a little bit of money flow out of bonds and some money move into equities, but as a percentage of their holdings, equities still are relatively low versus historical numbers, and bond holdings are relatively high. So we think it'll take a long time to close this gap. And in general, we want to be focused in equities and have less focus in bonds. Those numbers continue to be supportive. When we look at corporate balance sheets, they are flush with cash, $2 trillion. So we should expect there's going to be a continuation of share buybacks, and we should get some more announcements of that as we go through the quarter and earnings period. So last few things, volatility remains low and falling. That's healthy for markets. Credit spreads remain quite benign. The excess return bond investors' demand to buy corporate bonds versus government bonds has been falling steadily as they've gained comfort with the economic recovery. So let's look at it from our point of view. Our job is to find the leadership themes and focus in those areas, to always watch for change in leadership or new leadership to emerge. And in the event that our work points to deterioration, be prepared to play some defense. Last week, we talked about the fact that our long-term model for US stocks was positive and our long-term model for global stocks positive. We had a couple of short-term indicators that were weak, but that showed more consolidation. This is the percentage of stocks with upward trajectory. We know a lot of stocks have flattened out over the last 6 or 8 weeks. When we look at the data today, it's roughly the same. Just the percent of stocks with positive momentum has come down a little bit more. It means the market's been consolidating, but the long-term indicators remain firm. So it means we're comfortable being invested. We don't see significant bear markets. We don't see significant corrections without seeing deterioration in breadth first. So we'll watch those every day, but it causes us to continue to be pretty fully invested. From a sector exposure standpoint, not a lot of changes this week. Financials remain a significant piece of our portfolio, 32%. When you think about it, that's close to 3 times the index level at 11% in the S&P. So that's a very significant focus, we think, on financials where the risk reward is very good. Good valuations, good dividends, and likelihood for dividend increases as June comes around and the Fed allows them to start raising their dividends. A significant overweight in industrials, an underweight in technology because they're less economically sensitive, a significant overweight in materials, close to 3 times the market weight in materials, and an overweight in energy, a small underweight in consumer discretionary, and almost no exposure to the bond proxies. So the portfolios remain very unlike the index. They remain fairly fully invested. They remain focused in sectors and themes that are economically sensitive and will benefit from rising prices and rising demand. And on the income side, focused in dividend growth stocks. So if we see changes, we will get defensive. But at this point, we remain pretty optimistic and very interested to see how the earnings continue to flow over the course of the next 2 to 3 weeks. And we will continue to update you. And with that, Pam, if there's any questions, maybe we can answer them.
Of course. Thanks so much, Dave. First question, your thoughts on the Canadian dollar going forward?
This is the Canadian dollar firming versus US dollar. As I think most people know, in the pools that we run, we have been virtually 100% hedged back to Canadian dollars, even for all of our US and global investments, because our view is in a strengthening economy, generally, the Canadian dollar acts a lot more like commodities and emerging markets than it does the US dollar. And so we think that the Canadian dollar can continue to strengthen. I know that we have fiscal constraints in Canada. There's a lot of spending taking place, but generally the tightest correlation for the Canadian dollar is versus commodity prices. And when commodity prices are firming, generally the Canadian dollar is firming as well. So some of that has to do with the fact that the US dollar is just plain weak versus a lot of currencies, but the Canadian dollar is firming and is likely to continue to firm versus US dollar.
Thanks so much, Dave. I know the global macro strategy is expressed using ETFs, but how does Barometer think about investing in ETFs in their other pools versus individual stocks?
It's a great question. When our breadth model, for instance, so the way that the breadth model works is if there was 100 companies in a sector, we track the long-term trend for all 100, and we measure the percentage of stocks in that universe that are performing constructively, where they're making higher highs and higher lows. So when a group has been out of favor for a period of time and breadth is narrow, but then starts to improve, that's new money getting put to work. And that will often cause us to say, well, we should have some exposure in that sector. Often it's at a time when it's been out of favor and is unloved. And that gives us early entries. But very often it can be a little confusing as to where we want to put our exposure down. So we may choose at the beginning of a new structural theme to start by buying an ETF that is expressing that sector as a whole. And then often we will add individual holdings based on the strongest companies within that group. And that might result in us taking exposure in the ETF off as we add individual securities. Similarly, if our market model was negative and we had a significant cash weight and our indicators start to turn positive, we may start by buying units of the SPDR, the S&P 500 ETF, or the NASDAQ ETF. And again, as we start to put on individual positions, we would take down the exposure to the ETF. The third way we might use it is if, for instance, in a long short portfolio, if we were long or owned securities in a specific theme or industry, and we got cautious short term, we might sell an ETF for that universe against it just to reduce or hedge our exposure in that area. So ETFs have a lot of different purposes. Generally, they will give us exposure to a key theme. And the fact is that when we look at sources of return, 80% of return in a portfolio comes from getting to the right asset class, like stocks or bonds or commodities. And then second, finding the right sector or theme. 80% just get the right theme and the right asset class, and that gives you the return. 20% comes from finding the security with the right business characteristics to outperform the other companies within that theme. And that's why rifle shot individual security selection is the route to go in some of the portfolios like the equity portfolio.
Thanks so much, Dave. The next question we have is about artificial intelligence and what our thoughts are and how we would be thinking about investing in this particular space.
Well, it's a great question. A lot of the companies in this area are relatively new. Some of them have small revenue lines, although, there's a lot of ways to look at it. Artificial intelligence is very data centric. So companies that are big database companies will be part of that process. Companies that are, providing cloud-based services are part of, the ecosystem for artificial intelligence. And there are companies that are very specifically focused on artificial intelligence. We own a small stake. We owned through the fall. We had to exit because it started to sell off, and we just recently repurchased some exposure in a company called Veritone. And Veritone is a operating system for companies building artificial intelligence software. So it's like Microsoft building Windows platform or Azure platform, and then providing that underneath other software providers. So this is one that's a higher risk company because it's a younger company. The other way is you can access sort of through an ETF, but hard to get very specific exposure other than going rifle shot.
Thanks so much, Dave. The next question is from Stephen in Toronto. He's wondering how, from a year-to-date perspective, our income and balance pools are doing relative to our competitors.
That's a great question. They're doing very well. The fact that we're focused on dividend growth is allowing us to outperform certain of the peers. Many peers are focused on corporate credit, high yield bonds, high dividend paying stocks, because that has what most income portfolios have focused on over the last number of years. And while the yields might be a little bit higher, the total return, like the return for the securities themselves plus the income, has been much higher in dividend growth. So I'm pleased with how things are going in both the income and the balance portfolio.
Final question: forestry stocks.
Pam, sorry, just to qualify that.
Yep.
Qualify it. I mean, this is what's been going on in the bond market. So bond returns, whether you're looking at short-term bonds or whether you're looking at long-term bonds, are negative across the board. And so, without a fixed income component in the income portfolio, it's been a big advantage.
Thanks so much, Dave. And the final question is on forestry stocks. They took a bit of a hit today, and we're just wondering what your thoughts are, if any, on that sector.
Look, commodity prices move around. And this is the ETF that owns forest product stocks going back to last June. So how many times have you seen 3 or 4% pullbacks? Lots. So the fact that we've had a 3-day pullback and the ETF has come from 94.50 to 92 is like a 2% move. So obviously some might get impacted a little bit more than others, but Interfor, it's pulled back for a couple of days. It's done it lots of times over the course, and it's going to continue to. Canfor is similar. So I think these are probably more entry opportunities. I know I topped up the WOOD ETF this morning at about 10:30. We have about a 2.5% weight. I think I added another 1%. But you want to look at these companies, these opportunities to buy on pullbacks in the context of an uptrend. If you take the copper producers, it's similar. Like there have been a couple of good sized pullbacks along the way, and there's going to continue to be. And these are opportunities kind of to add as it pulls back into long-term trend.
Thanks so much, Dave. Well, that concludes our questions for this afternoon. So I'll leave you with the final word.
Well, we will watch with interest, not only to what the earnings are, but more importantly, what the reaction to the earnings is. So there are high expectations for this quarter's earnings. What I think is going to be more important is the commentary that comes with the earnings. For instance, a number of the semiconductor companies, are they going to be able to catch up with demand? Some of the auto companies, are they going to be able to deliver on their earlier forecasts given some of the slowdowns in manufacturing? So very often, I think the way the market reacts to news is more important than the news itself. So far, I've been pleased with the way that our companies have responded to their earnings reports. We've had some nice jumps on their earnings reports. We'll see how that goes for the next 2 to 3 weeks, and we'll see how Brent holds up. We know that seasonally markets can weaken a little bit in May and June. So we're certainly aware of that and watching for that. But at this point, I'm amazed at how well the market is absorbing news. That the rebalancing at the end of last quarter could have been quite significant in the market, and the market absorbed it all. So I think that the market continues to act like a bull market, and we'll be watching that as we go forward.
Thanks so much.
Thanks very much for joining, everybody. And certainly if you have additional questions we haven't answered, don't hesitate to reach out. I've been in the process of trying to do some meetings with folks and answer any questions that they have. If you'd like to ask questions on the public market stuff or have questions on our new music fund, certainly happy to answer that as well. We have a number of webcasts coming up over the next 2 and 3 weeks on that if you'd like to join. And with that, we'll say goodbye and look forward to seeing you again next week. Thanks.
Bye, everyone. Thanks, Dave.